associated with the persisting trade wars between the US and its major trading partners, financial vulnerabilities, rising levels of public and corporate debts, pockets of geopolitical tensions, and weakening global output. However, the reforms underway in the domestic economy aimed at diversifying the economy away from oil over the last 3 years have provided adequate shock absorber to withstand the headwinds. However, the committee urged the fiscal authorities to invest massively in public works program and improve fiscal buffers to complement these efforts. Forecasts of key macroeconomic variables, however, indicate prospects of improved output growth for the economy. Based on recent revised projections, the economy is expected to grow in 2019 by 2.3%, IMF estimate, 2.1% by the World Bank, and 2.2% the CBN staff estimates. Committee noted the tailwinds to these developments to include sustained stable exchange rate, enhanced flow of credit from the deposit money banks to the private sector, expected improvements in tax revenue and efficiency in public expenditure, continued improvements in the business environment and activities, and the sustained intervention by the bank in the real sector. Committee's considerations. The committee welcomed the improvements in output growth in the third quarter of 2019, noting that the current direction of Purchasing Managers Index suggests stronger growth in the fourth quarter. It, however, re-emphasized the need for diversification to strengthen the productive base of the economy and reduce dependence on oil. Diversification has become necessary now that Nigeria has signed the African Continental Free Trade Agreement, AfCFTA. To achieve this, the committee urged the federal government to continue to improve the investment climate and ease of doing business to attract foreign direct investment. Particularly, the government should, as a priority, improve conditions for global auto manufacturers, including for aviation and rail industries, to invest in the country. The committee commended the expansion in manufacturing output, noting that it was a direct fallout to the policy on loan deposit ratio. The committee called on government to urge the Pensions Commission to improve the prudential requirements for pension funds to refocus their investment portfolio away from their traditional choice of government securities in favor of other viable long-term investments in real sector, in real estate, manufacturing, agriculture, and indeed infrastructure. Moreover, the committee called on strong visibility of fiscal and structural policies to improve infrastructure and investment conditions in the economy. It expressed strong optimism that the current policies of the bank, in a regime of solid fiscal and structural policy support, will yield strong dividends in closing the current negative output gap in the medium to long term and place the economy on a sustainable and self-sufficient path of growth, of output growth. As a key pillar of economic diversification, the MPC directed the attention of fiscal authorities to the immense potentials of the gas subsector and the urgency to encourage horizontal integration through private sector participation. This, the committee argued, will improve domestic power supply and export earnings. On price development, committee considered the moderate uptick in headline inflation in October 2019, attributing it partly to an expected temporary shortfall in food supply because of the recent land border closure and rise in demand as the festive season approaches. Although it noted that the price increase was not unexpected, it serves as a cost of the closure, which is lower than the medium-term benefits. Consequently, it noted the need to drive down food prices through increased support for local production of staple foods, including rice, fish, poultry, palm oil, tomatoes, and etc. It also urged government to follow through with a sustainable policy on backward integration in the milk industry and other priority sectors of the economy. On the fiscal sector, the committee identified the need for institutional reforms through policies that would automate day-to-day processes of key revenue-generating and security institutions such as Nigerian customs. This will provide additional advantage of stemming smuggling, kidnapping, and the migration of terrorists into the country. The MPC reiterated the need for increased efficiency in public expenditure and the building of fiscal buffers. On the impact of the recent closure of the Nigerian land borders on domestic food prices, the committee noted that any upward price movement arising from the closure was reactionary and therefore temporary. Moreover, significant investment has been made over the last 3 years to sustainably increase domestic food supply. It noted some of the key initiatives in this direction to include the commodity development initiatives designed to finance the agricultural value chain of 10 commodities, namely cassava, cocoa, cotton and textiles, rice, tomatoes, poultry, livestock and dairy, fish, oil palm, and maize, which has received 171.6 billion naira in funding. 4 of these crops received over 140 billion naira, or 81.6% of total disbursements, cassava 11.4 billion naira, cotton 40.47 billion naira, rice 53.4 billion naira, and oil palm 34.81 billion naira. It is therefore expected that the outcome of these interventions will close the supply gap already envisaged in the medium to long term, including dampening domestic prices. It therefore expressed support for the temporary closure of Nigeria's land borders, noting that securing the country's land borders should be further enhanced. On crude oil price, the committee noted the lull in the futures market, suggesting that prices will remain relatively weak into the foreseeable future. The committee therefore urged the federal government to reconsider its 2020 budget oil price benchmark of $57 to the barrel to build buffers. The committee was confident that despite the weaknesses from the external sector, efforts to ramp up domestic production through several measures by both the monetary and fiscal authorities will douse the adverse effect on the domestic economy in the medium term through reduction of importation of food and commodities. Committee's decision. The Monetary Policy Committee reviewed the upsides and the downsides of the options to tighten, hold, or to loosen. It was conscious that while tightening may encourage capital flows, it also has the downside consequence of stifling of the already nascent recovery in output growth. The committee also noted that a reduction in policy rate will improve growth prospects, but in view of the uptick in inflationary pressures, it decided that the balance of risk was in favor of protecting price stability. Considering the recovery, decline in market interest rates, growth in domestic credit amongst other positive developments, the committee felt that there would be more gains in the shortfall to medium term in holding policy at its current position. In its consideration to hold, the monetary policy noted with pleasure the positive outcomes of actions already taken by the bank. These actions include the current policy on loan-to-deposit ratio, which has resulted in loans and advances rising by over 1.1 trillion naira between June to October 2019. It further noted that these actions have assisted in boosting credit to the agricultural and manufacturing sectors, hence the positive outcome on the gross domestic product. The MPC is hopeful that the loan-to-deposit ratio initiative must be sustained, as interest rates being paid by borrowers have so far dropped by up to 400 basis points between June and now. These have happened with corresponding decline in non-performing loans ratio to 6.5% at the end of October 2019. The MPC is therefore of the view that sustaining the MPR at its current level is crucial for better understanding of the impetus of growth before deciding on any probable variations. The MPC also feels that holding its current policy position offers pathways for appraising the effect of the heterodox policy to encourage lending by the banking industry without varying the policy rate, as the downside risk to growth and caution on inflation looks stable. The MPC is also of the view that the improvements in the macroeconomic indicators, such as the gross domestic product, the non-performing loans ratio, the capital adequacy ratio of the banks, as well as the loan-to-deposit ratio, suggest that the current monetary policy stance is yielding results. It therefore feels that maintaining the current stance will be necessary in order to sustain these improvements. In view of the foregoing, the committee decided by a unanimous vote to retain the policy rate at 13.5% and to hold all other policy parameters constant. In summary, the MPC voted to 1. Retain the MPR at 13.5%, 2. Retain the asymmetric corridor at plus 200 and minus 500 basis points around the MPR, 3. Retain the CRR at 22.5, and retain the liquidity ratio at 30%. I thank you for listening.
Ladies and gentlemen, that was the MPC communique as released today and as read by the Governor of the Central Bank of Nigeria, Mr. Godwin Emefiele. Welcome to the question and answer session. As usual, we have our house rules. You come up here, ask one question unless they are linked, unless they are really related, and we know how questions give birth. And then ask your question and then listen for the answer. Please, if you have questions, can you come close to me? Please, you have to come up here. Okay. Nancy, your name, your position, your question.
Good afternoon, Nancy. Executive Producer, Nancy. Let me ask this question. The capital importation reports that the NPS just released, it shows that perhaps Nigeria is not an attractive place right now to do business, because if we're going to be pursuing growth in elastic sectors that would create jobs. What perhaps the MPC deliberate on that, and perhaps what's your advice to government? The other question is on inflation, perhaps as it also relates to border closure, because a lot of analysts and perhaps your critics, or the CBN's critics, have said that inflation would definitely continue if we don't have locally backed production to ramp up supply. What is your response to that? And perhaps even as importers take their goods to other neighboring countries, what is your advice? Is the inflationary pressure in Nigeria, is it really a monetary phenomenon, a monetary condition, or is it as a result of supply shocks and output constraints. Thank you.
Thank you. Okay. Good afternoon, everybody. Board members, Governor.
Hold on, please. Yes.
Okay, Alonso Soto with Bloomberg.
Where?
Bloomberg. Yeah. Governor, we have seen this week that foreign reserves actually fell below 40 billion for the first time in quite a few years. We have seen reports of foreign portfolio investment outflows, and we have seen that the balance of payments has turned negative in the first half of this year. I wanted to ask you how sustainable is keeping the quasi-peg on the naira versus the dollar, and what are the parameters?
Hold on, how sustainable is keeping the precise peg?
And what parameters is the central bank using to make that decision? If it is the reserves, if it is oil prices, can you tell us a little bit more about that?
Okay. What parameters?
Thank you.
Is CBN using?
The governor of the central bank, Godwin Emefiele, speaking there. Of course, he just announced the decisions to hold all interest rate parameters unchanged. We have a few minutes left for this panel discussions. Of course, he's taking questions from members of the press, but here at our headquarters is Biodun Kerikwe of Afrinvest, Wale Olusi of United Capital, and Mustafa Wahab from Kodos Capital. Gentlemen, let's have about a minute each. The governor seems to spend more time to provide clarity and details as to how much has been spent into those sectoral interventions and all of that. I think he deliberately did that so that everyone out there will have an idea of how much has been spent. And if we're talking about the third quarter GDP and the outlook for Q4, we'll have an idea who gets what sectors get what, in terms of credit and in terms of direct interventions by the central bank. Let's start with you, Mustafa.
Clearly, I mean, it's actually a growth story for the CBN. They want to ensure that they are pushing a lot of credits to the real sector, wherein a lot of businesses are sort of expanding their operations, and the ones who are carrying a lot of heavy borrowings in their books, they can go to the market, refinance at cheaper borrowing. That would free a lot of capital for further expansion in the businesses, clearly. So, I mean, with these numbers coming out in front of us, I mean, I hear that manufacturing sector actually got the biggest
chunk of
the loans, as well as consumer loans, right? So the impact of that is just basically going to be pushing purchasing power more strongly, where a lot of consumers actually have cash in their wallet to now spend. Manufacturers are also looking good in terms of disbursement. So, I mean, overall, growth should actually be largely driven by non-oil, at least in Q4, with these numbers that we have.
Wale Olusi, this is do nothing in terms of the key parameters, but in terms of the details provided, it looks like the central bank or the MPC is telling everyone, this is where we're going, this is what we're doing, and this is have an idea of where we're going. Is that what you read from his MPC communique?
Absolutely. I mean, if I hear them right, it looks like tacitly they are trying to calm, everybody down, because there's this whole, thing about inflation is, food inflation is on the rise. But if you look at the targeted sectors that the credit have, focused on, manufacturing, consumer goods, general commerce, construction, ICT, agri, apart from that, they spent a whole lot of time on, trying to show that the current, spike in food prices is temporary, and there's a possibility that whatever, is happening between Nigeria and, this neighboring country, there will be an agreement very soon, and with the increased support from the central bank, and, while urging the fiscal policy side to also do something, there will be, a little bit of increase in or an improvement in the supply shortages that is, responsible for this price spike in prices. So I think that's the focus.
Yes, Biodun, but again, this is this MPC asking this government to step back, the executive to reconsider the oil price benchmark in budget 2020 to brief buffers. And that spoke to what we said earlier. The foreign FX reserves is going down, is down to $39 billion. This is tacitly telling the executive branch we need to watch this cup from being half full to half empty.
Correct.
Exactly.
Correct, yes.
Yes.
So, yeah, basically, they sort of need to be, of course, the budget benchmark has been set. for the crude price, so nothing much can be done about that for now. So, and the committee also spoke a lot about the need to keep the border closed or secured. So, which speaks to what the fiscal angle too are doing, that if at all they're considering any closure, it's going to be to January 2020. And the need that they need to curtail or curb the level of infiltration in terms of firearms and, you know, the likes in economy is critical also. So this speaks also to that. And all in all, I think what they've done with this meeting, the last meeting sort of for the year, is to, in a way, calm tension, tell us that we should focus more on those unorthodox strategies they've been using to manage price level, to manage system liquidity and all of that. So looking forward, I think here, growth outlook, I mean, listening to Emefiele now, you suddenly just turn bullish listening to him right now. So you just suddenly think that, yeah, growth outlook forward.
Thank you. Thank you, gentlemen.
Positive.
We thank you very much for your time. Thank you very much, Mustafa Wahab from Kodos Capital, Wale Lucy from United Capital. Thank you so much, and Abiodun Keripe from Afrinvest. And we thank our viewers here in Nigeria and around the world. We do apologize we couldn't cross over to our Abuja studios to take our guest who was there. This is special programming on Central Bank Monetary Policy Decision Day, the final in 2019. I'm Boosting Namafaye, and I'll see you pretty soon. Thank you very much for watching.